Good morning. Welcome to Stock Market Today for Thursday, April 9th, 2020. I am your host, Dan Russo, the Chief Market Strategist at Chaikin Analytics. Find me on Twitter at DanRusso_CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com/today. Sign up for a free email where we get a lot of the content for this show. Also gives you daily stock ideas to consider for further research. Every day hits your inbox before the market opens. Just a quick programming note. Tomorrow is the Good Friday holiday and markets are closed, so there will not be a show. Diving right in now, U.S. equities ended higher in Wednesday's trading, finishing just off the best levels of the day. All sectors were higher, led by REITs and energy. Consumer staples underperformed. Treasuries were mixed with the curve steepening. The dollar was stronger versus the euro, a little changed against the yen. Gold finished flat and WTI crude closed up 6% after headlines pointed to a large potential output cut from the OPEC Plus meeting scheduled for later today. As we get to the desk this morning, futures are down about 50 basis points in early trading. As Asian equities finished mostly higher overnight, led by Australia, Hong Kong, and South Korea. European markets are mixed. Treasuries are stronger across the curve. The dollar is mixed on the major crosses. Gold is up 1.2%, and WTI crude is adding on, up another 6.5% here this morning. So yesterday's rally took the index to Tuesday's high, and futures are down slightly here this morning. So that kind of, for me, sets this 2650 level as initial support. Should we begin to fade, we would want to look for that level to hold. Below that, we have to start thinking about the lows from last week in and around the 2450 area. Resistance does remain in the 2800 to 2900 zone. RSI holds bearish ranges that's below 60. So despite the big rally, we haven't seen the kind of big RSI thrusts that would be, somewhat more encouraging if you wanted to remain bullish here. Chaikin money flow is bullish, but fading. So not a ton changing here in the day-to-day. We basically rallied back towards Tuesday's high from which we faded, establishing 2650. We actually got pretty close to that level again yesterday. So that to me gives you a near-term line in the sand on the downside for initial support. Moving now to our market in a minute. What are we writing about in our note today? Well, it's breath day, so we'll touch on breath. We do that every Thursday in our note to Chaikin clients. So the SPY rallied more than 3%. It's now approaching the 50% retracement of the move down. We'll take a look at that a little bit later on in the show. We're expected to get initial jobless claims today at 8:30. Estimates stand at about 5 million. Remember, the number last week was about 6.6 million, which was more than double what was being expected. So expect another big number. A lot of moving parts. Estimates vary, so we'll just have to see what happens with that number. But more importantly, as we've seen in the past with these labor numbers, I think it's more important to focus on the market's reaction in the near term. We're starting to see some diminishing relative strength in QQQ, and that's interesting to me. I'll even point out that the NASDAQ underperformed yesterday in just a moment, and futures point to a flat to slightly lower open here today. Turning now to the power bars for the major indices, the Dow added 3.4% yesterday, 1 to 7 bulls to bears. S&P 500, slight improvement there with a 3.34% rally, 26 to 136 bulls to bears. There's your NASDAQ underperforming by about 1.3% on the day, 13 to 22 bulls to bears, but we're focused in on what appears to be, at least in the near term, some diminishing relative strength in the NASDAQ. Small caps, on the other hand, outperformed yesterday. Not often that we've had a chance to say that, but the past couple of days it's been the case. 119 to 468 bulls to bears. Bonds downtick, sending yields higher. REITs were a standout group yesterday, up 7.5%. 3 bulls to 14 bears in the real estate sector. So according to the Chaikin Power Bar, small cap stocks and large cap stocks are bearish. Major indexes are mixed to bearish. Turning now to our screen of the day. I've gotten a lot of good feedback in my notes where I've been including screens for our clients, both on the bullish potential screens as well as bearish potential screens. And I wanted to look at a screen today where we screen for what could potentially be stocks that are exhibiting a personality change, i.e. they go from outperforming to underperforming. So it's a feature that we have at Chaikin Analytics. I can screen the Russell 3000 for stocks that have a neutral or lower Chaikin Power Gauge rating. And then I looked at their money flow. I wanted to see stocks that had a 1-month low in persistency, as well as relative strength that turned weak this week. So if we think about what that is the market kind of has rallied hard here and is overbought in the near term and approaching a key retracement level. What are some stocks that if you own, maybe you want to lighten up, or if you trade to the bearish side, maybe you want to explore opportunities there? Well, this screen returned 14 names. It's included in my note today, and I'm sharing it here with you all on a Thursday morning. Some names that have been highlights for us lately: VMC and Zendesk. But this list of 14 stocks are exhibiting what could potentially be what we call personality changes. Essentially, going from outperforming to starting to underperform in conjunction with a not bullish rating and money flow being under pressure in the near term, a sign of distribution. So it's an interesting screen, 14 names that could warrant some additional attention and exploration on the bearish side of the portfolio. Turning now to our sector tracker, the movement of the major sectors over the last 5 days. We've had a big rally over the past week, so everything is green, led by energy, right? Talks of potential production cuts as it relates to oil has lent a nice bid to energy here in the near term. It's had a good pop if you look at the XLE. Fundamentals are still bearish, as we've been saying. We'll have to see how things shake out following this cut. That OPEC plus meeting is scheduled for later today. Real estate, materials, and fins round out the top of the list. Discretionary utilities, tech, and healthcare are middle of the road. And down at the bottom, underperforming industrials, comms, and staples, with I guess the staples coming under pressure as there's been a little bit more of a risk-on appetite in the marketplace. Staples had been good leadership, so just something to keep in mind there going forward. Want to watch that closely. If staples continue to lag, that could be a sign that the bullish trend is taking hold. If we start to see staples leading again, to me that would be a sign of caution in the marketplace. Turning now to our industry in focus, it's insurance services. Auto-generated here, and then I present it to you and analyze it in real time. It's underperformed over the past 6 months, lagging the S&P 500 by nearly 16%. And its power bar ratio, which measures future potential, is weak, with 3 bearish stocks and only 1 bullish or very bullish stock. And even with that ratio, though, it's in the top third of the 21 subsectors that we track, having moved up 12 slots over the past week. So names there that we want to avoid still. Very bearish RLI Corp, ticker RLI. Erie Indemnity, ERIE, has a bearish rating, and Willis Towers Watson, which is involved in some M&A activity, is a bearish rating. So we want to avoid those names. And really, the group just doesn't look that compelling to me, even with this rally here. The ETF power gauge rating is neutral. There's that ratio, 1 bull to 3 bears for a fund that is in a weak trend, right? A lot of weak trends, then below this declining long-term trend line. So that neutral rating is met with a fund that's been drastically underperforming the market since October. Overbought, oversold indicator now in an overbought condition with bearish money flow. So to me, if I owned insurance stocks, I'd want to be paying close attention to how the group is trading here, because a lot of names are overbought. The fund is overbought. Money flow is bearish. If you've had a nice run here off the lows in some of the insurance stocks, might make sense to square up portfolios a little bit, maybe weed out some names that are marginal. But this is just a group that doesn't look all that compelling to me here in the near term, right? With the market being volatile and still very much under pressure, right? We've had a rally here over the past week and a half or so, but we're still in a downtrend. We want to focus on the areas of the market that have been leading, not the areas of the market that have been lagging through the downtrend. So KIE fits the latter group, lagging through the downtrend. Turning now to what's trending. Yesterday's S&P 500 gainers and losers are movers and shakers. APA up 16.25% on that rally in crude oil and trading higher again here this morning. WELL, part of a group of healthcare REITs and senior living facility names that have caught a bit of a relief rally of late. TransDigm TDG, very bearish stock, rallies from deep, after a deep sell-off, up 14.5%. ADS continues to rebound after being hit extremely hard. I will note that stock did catch a downgrade yesterday, but notwithstanding that downgrade, the stock did rally 14.5%. on the day. DXC rounds out the list of gainers, 13.5% to the good. Didn't see anything company specific there to take that stack higher. On the loser side of the board, Old Dominion Freight Lines, ODFL, caught a downgrade at Bank of America Merrill Lynch yesterday. Stock down a little over 3%. Kroger down 2.6%, part of that Staples group that underperformed yesterday. Kroger's actually been one of the compelling names here in the market as it's sold off. So as we've gotten a rally, maybe a bit of profit taking, but if you're moving forward with caution and you're trying to focus on names that could potentially do well on a relative basis, given the volatility in the market, Kroger still fits the bill as far as I'm concerned. Kellogg, same story here. Part of the Staples group that underperformed, another name that benefited as markets sold off and seeing a little bit of profit taking there, down 1.75% yesterday. Letter J, nothing company specific to drive that stock lower by a little over 1%. In Hormel, same stories as Kroger and Kellogg, part of that Staples group. Those defensive trades are coming off a little bit here in the near term. We'll see if that's a trend that sticks or if markets turn choppy again and investors gravitate back towards the staples. So taking a look at the S&P 500 and actually introducing a different look from the indicator perspective. S&P 500 from that high down to the low. The high on February 19th, the low on March 23rd. And we rallied back to the 38% retracement level and then faded, finally busted through on Monday. And now we're holding above 2650, as I've said. But now we're approaching the 50% retracement level as the fund is overbought. I'm looking at the CCI now as an indicator, a kind of more sensitive indicator than RSI, and it is overbought and on the 13 period time frame, and I even overlaid a 3-day moving average, that's the blue line, to kind of smooth things out a bit, and we're overbought as we approach this resistance level. So we've had a nice run here in the market off the lows, and we want to pay attention and respect resistance levels, especially when we're overbought. Ideally, we'd love to see 2650 hold. If 2650 fails to hold, as I've said, we're looking at 2450 potentially to the downside, or maybe just fill this gap. So, it's just the conversations I think you need to be having with yourself, right? If this, then that. If we fade below the 50% retracement level, where can we go? And what do we want to see? Should that happen? Well, ideally, we'd love to see a pullback that keeps the CCI above zero or prevents it from becoming oversold. To me, that would be a sign that might make sense to look for some bullish opportunities in the marketplace. Now, what if we break above the 50%? Well, you have upside to the 61.8% retracement level. So that's kind of the roadmap and how I'm framing it up here in the near term. So just the way I'm kind of viewing the world right now in still what is a very volatile environment. So what about the Qs, right? I said we wanted to look at the relative strength in the Qs. But I thought we'd frame it up pretty much the same way as we just did the S&P 500. So the Qs have hit their 50% retracement level. They hit it on Tuesday and then faded. Tried to get back above it again yesterday and couldn't. Close very much near that level. Call it $200. Here too, that 13-period CCI with the moving average is overbought. But what's jumping out at me is the fading relative strength of late of the Qs. Now, Qs have been strong leadership, and even through the downturn, they were strong leadership, going down less than the overall market. So now, as we see the rally continue for the S&P 500, we're starting to see the Qs lag. So that's something I'm going to be watching very, very closely. Even yesterday, market up 3.5%, Qs only up 2%. Finally, breadth is improving. Percentage of stocks above their 200-day moving average crosses above the 15% mark. Same goes for the percentage of stocks above their 50-day moving average. What I will say is that in the near term, the percentage of stocks above their 20-day moving average hit 96%. And historically, over the next month of trading, when that metric has crossed 95, trading's been choppy with a downside bias over the next month of trading. So that's how I'm viewing the world these days. I hope that everybody has a great 3-day weekend. I will be back here with you on Monday. Have a great Thursday afternoon, everyone.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.